Okay, good afternoon, good morning, good evening, good afternoon, wherever you are. We have people logging in from all over the globe, and we're happy that you joined us, and thank you everybody for joining us. Give a couple minutes just to let people join in, and then we will, I see people are already starting to join us, and we'll just give a moment or two for people to join, and we will begin. Just wait one moment. Okay, all right, well, thank you, everybody. Thanks for joining. We're happy that everybody is here. Welcome to our market update webinar as a kind of the closing from Q4 of 2023 and also looking forward into 2024. We're happy and excited to be able to share with everybody some of our findings, our outlook, some of the research, some of the things that we're thinking about. And so we appreciate everybody joining. Hopefully it'll be a good quality and valuable few minutes here. So here's just general disclosures. Obviously, nothing here is a solicitation for security, and there is no advice, and I highly recommend everybody read the general disclosures, and they're relevant also for this webinar. Today, our discussion with our panelists are myself, and where we have David Molitor, our head of operations, and Cesar Nguyen, director of acquisitions. David's going to talk about some of what he sees from the operation side within the HLC portfolio and other operators in our markets, and Cesar will also discuss from an investment and acquisition standpoint what we're seeing. First, I'm just going to take the opportunity to discuss a couple kind of broader themes on the macro environment, but I'm going to specifically speak to this time to multifamily and kind of some larger themes that we're seeing just overall in the market. And hopefully from here, we'll also dig down deeper into what some of these themes mean and how they're being seen and implemented within our properties on a day-to-day basis. So to start with, we have an increase in loan defaults. There's really been somewhat of a surge and also an expectation for more of a surge in loan defaults throughout the market. There's reason for concern that surge in multifamily defaults will be further felt as we go along in the year. Fitch Ratings predicts apartment delinquencies for the CMBS market could reach 1.3 billion this year, and that would surpass the losses during the pandemic. Another theme is the rising delinquencies. So delinquency rates on CMBS loans has already risen. It grew from 1.6% 6 months prior to 2.6% in December. So from December, if you go back, it was 1.6, and in December it was 2.6. That's according to TREP. And with market challenges prevailing, the rate is likely to continue in the short term. And so that's just something that we're tracking. Obviously, it has wide implications. And then there's also within the multifamily market, and it's more impactful in certain markets than others, there's a surge in new supply. So potential headwinds could come due to the record new supply, which is due to hit the market. There's about 900,000 units that are under construction and over 440,000 units that are set to be delivered this year, according to CBRE. The influx of inventory can negatively impact revenue growth, and that comes alongside increased expenses, more challenges for owners to meet their debt, and it will create just more challenges for owners to meet their debt service obligations, and it creates a short-term challenge, obviously. But we also feel very strongly that in the long term, so if we call it 3 to 4 years from now, there is that continual demand for multifamily housing. So it will create short-term challenges, but we feel very strongly, and what we're seeing in the market, and also based off of all the data that we see in terms of the millions of homes that are lacking in the US, in the long term, multifamily will still remain very strong with all of the demand that's there. And then we have a loan maturity challenge. So over 3.12 billion in conduit and agency CMBS loans are set to mature this year. It's an expected additional 37.9 billion will mature in 2025. And in 2023, the number was 26.5 billion. So, obviously this just shows a rising trend in maturities, and it comes at a time when obviously interest rates make it increasingly challenging for people to refinance into some sort of other debt vehicle. And this pain is mainly being felt in retail, office, and in multifamily. The other item that we should talk about is gap financing. So approximately, and this is also based off of TREP, approximately $1 trillion in total multifamily debt is set to mature by 2028. And the industry experts project that by 2025, it may be easier to refinance, but the possibility of needing to contribute funds for refinancing remains very high. Even if interest rates do go down, a good bit, that possibility still does remain high. Limited distress. So with all of these challenges I just pointed out, the market overall is still strong. There's pockets of distress, and there's expectation that possibly things will get worse, but there's also we're seeing limited distress. A lot of people are surprised by that, and especially when it comes to institutional assets, we're seeing a lot less distress right now. It's expected, and one of the reasons why this may be the case, because a lot of the debt challenges are kind of getting worked out behind the scenes up until now. Either lenders were debt funds with short-term debt, and they were able to work out some sort of an extension behind the scenes, or the loans may have been loan-to-own scenarios where the debt fund is also an operator of properties, and the borrower defaulted, but nobody really felt it because the lender just took over the property. And for them, when life went on as usual, although the borrower did lose their property. So starting to see more of that, but again, it's not being felt in the market and as much as we would have thought that it would be, and a lot of it is possibly because of that. Most opportunities currently seem to be with some preferred equity investments in order to bridge the interim pain in the market. And the longer outlook on real estate owners who can hold on for a longer period of time does seem positive, but it requires the resilience to be able to hold over a challenging and volatile period of time. Going kind of forward, the bottom line, we do feel that there is opportunity on the horizon whenever there are these types of dislocations in the market. Usually, if you play your cards right and you're patient, you're able to find various opportunities. So due to the challenges in the capital markets, developers are likely to scale back on new projects. And then there's the projection that the Fed may cut rates in the second half of 2024, although obviously that's yet to be seen. The long-term apartment housing demand remains very strong, and we feel that solid operators who can weather current market turbulence and new inventory deliveries will be able to hold out and benefit from the long-term demand. And especially in growing markets that places where we focus on, like Texas, in certain degrees, Oklahoma, and some other markets as well where we focus. Cap rates have continued to rise. Obviously, with that, the debt, interest rates have also continued to rise. But depending on the market and the vintage of properties, they can trade anywhere between a 5 to 6% cap rate. And Caesar will get a little bit more detailed in terms of what that means, and how that's implemented in the market. But those are historically, pretty solid yields on good multifamily, solid income producing properties. So we are seeing that the yields are actually quite attractive, but obviously the interest rates are also pretty high relative to what they have been the last 10, 15 years. The main challenge remains the higher interest rates, and therefore there's an advantage for those who can wait out the current elevated debt service and expenses, and like I said before, those who can hold throughout this period of time for a longer duration are likely, we feel, are likely to come out well during this period of time. So those are kind of like the high level themes that I wanted to open up with when it comes to the multifamily market, which, as you know, our investors know, is not the only market that we focus on, but it is what we've done most of the last several years. And now I would like to hand it over to Caesar, so he can run through what he's seeing in the day-to-day acquisition activity. Please, Caesar.
Yeah, Daniel, thank you. And just a quick reminder for everyone, if you have any questions, feel free to put them in the Q&A section, and we'll address them toward the end of this presentation. But on my end, on acquisition front, looking back at 2023, I have to recap that it was a year of uncertainty. When you look at the 10-year Treasury, how it moved, so it started out the year around 3.9%, and then picked it off about 5 in mid-October, and then went back down to 3.9 again at the end of the year. So this whiplash in interest rate really had a tremendous impact on investment sale market. Overall, everything was frozen in terms of volumes. 2023 transaction volume was down 63% compared to 2022. And when we had discussion with all the major brokerage firms, their feedback was that half the deal that went into contract in 2023 did not materialize. It is necessarily fall-out contract, and the one that they was able to close, they are mainly loan assumption deal, essentially deal with long-term fixed rate debt that essentially take away the interest rate volatility out of the equations and help the buyer to lock in a decent deal. And the majority of the buyer was 1031 buyers, family office with long-term patient capital that took advantage of the opportunity to buy a deal that they like in the good locations. So those are mainly the deal that have materialized, and we'll continue, to continue to track the market. We'll keep everyone updated on how it goes, but we do think 2024 and 2025 will be pivotal years for all of us who are being patient. We've been patient with our capital, looking for the right deal. So moving on to the next slides. The reason why we say that is that looking at the overall debt maturity, we see there'll be loan distress on the horizon. When you look at 2023, there was almost $200 billion worth of multifamily loan matured last year. However, the bulk of those loans was on the bank balance sheet. And we saw that a lot of banks were doing the extend and pretend. They gave a lot of their borrower ability to extend for another year or so to kick the can down the road and to work out situations. But those loans now roll into 2024, and from our perspective, the clock is running out. So they have to figure out some solutions, either sell or refinance. And that would lead into opportunity for a group like us who've been patient and waiting for the right moment to strike. Looking into 2024 and 2025, look at the right hand chart. Is the securitized floating rate multifamily loans. You see in 2024 and 2025, there's a high volume of those loans. High percentage of those loans are below 1.0 DSCR, which means that the owner will not be able to refinance, and they are forced to either sell or doing cash in refi. So that would be, depends on the strength of the sponsor. Though, those will dictate the outcome. This deal we'll see. Move on to the next slide. The next page. So when we look at when we talk to investment sale broker and research firm out there, we do think that cap rate overall are hitting their peak. Looking at CBRE data here, one thing that jumped out at me is that from December 2022 to December 2023, within that 1 year, when you look at the Class A multifamily and looking at the cap rate range, the spread between going in cap rate and exit cap rate has compressed. December 2022 was 36 bips spread, and now it's 11 bips. Does that mean that we are hitting the peak and at the top of the market? So now I think is time for reaccelerations. If we go out and do deals now, we'll be able to lock in some decent deal toward the bottom of the market, where the outcome of that will deliver a higher return for us. And as I mentioned before, a lot of debt fund lenders and bank, they gave their borrower time to work out situations, but only to the strong sponsor. The weak sponsor or the deal with weak fundamental, those deals will go on market either for sales or the lender will foreclose and then to work out situation and wait for an opportune time to sell. Our team actually was very close on getting a deal done late last year. We were chasing it, and the lender decided to foreclose on the asset and hold on the asset for a few more months and wait for the performance to improve, as well as capital market to recover, so that way they can recover, sell the deal at par on the loan basis. Our offer was 10 cents below par, so we were hoping we'll get that deal at that basis, but the lender decided not to. But I think that's going to be a lot of that happening in 2024 and 2025, and we are very optimistic that we will pick up something good for us. Going to the next page, looking forward, what we are watching. So here's a chart that Marcus and Millichap provide to the wider market on terms of supply pressure on the market. If you notice here, the red bubble, they are the market that have more than 3.5% of share of inventory, under construction, and they're all concentrated in Sunbelt market. So our view is that in this Sunbelt market and also some market in like Phoenix, Denver, Salt Lake City, those will have some short-term pain because of supply. Those will put a lot of downward pressure on rent and occupancy. And if the owner have new property coming online in 2024 and 2025, they will have to give away a lot of concessions to get renter in the door. Couple of example that I can think of is Austin and Nashville. In Nashville market, when we were touring that area, new property are giving away 3 months free rent to get tenants in the door, and in some pocket with a lot of construction, all the way up to 4 months free rent. That's a significant discount, and that in turn will have impact on the Class B multifamily, because historically Class A and Class B, you have the rent, the gap between Class A and Class B was 20 to 25%. But now as this Class A property are providing 3 months to 4 months of free rent, the tenants in Class B say, hey, we have a good opportunity to upgrade to a Class A, better quality, better locations, a similar price range. So they move up, and then the Class B occupancy went down, and then that will impact the operator, and they have to give away concession. So that's so on and so forth. So overall, I think this market with high supply will have some short-term pain, but kind of zooming out, we do see that these are market with strong fundamental. They have strong job growth, strong migration, population growth. Over time, over the long-term horizon, 5 to 10 years, they will outperform the rest of the country. So if we, from our perspective, buying deal in those markets today, if you can weather the short-term pain, you will come out, on top at the end of the day. Moving into the next slide, what we are pursuing. So again, kind of we still stick with our overall thesis. We have strong convictions that kind of bifurcated two buckets, the income and growth. The income bucket would be Class B workforce housing in a primary market where we can leverage our relationships to buy deal with a 6 cap or more going in, and then either put on long-term fixed rate financing from Fannie or Freddie, or assume existing fixed rate debt on the deal. If you buy a deal with 6 cap and put on Fannie or Freddie financing, which we can get around mid-5 today, you get positive leverage going in, and that will give us ability to drive higher cash on cash for our investor. And the growth bucket is the complete opposite, where I had mentioned before, where we target market that have a lot of supply coming online. There will be a lot of distress and a lot of pain. We'll buy those newer apartment building from owner and developer at a decent basis, and put on, and we'll have strong reserve to allow us to weather a couple of years of pain. But then we own a good asset in good location in a high growth area, and we also expanding our search to a lot of secondary markets. In the chart here that I provide is the data from Freddie Mac. They see that the top 10 MSA with rent growth and low vacancy, you'll see all of them are in the secondary market. Places like Oklahoma City, Albuquerque, Tulsa, Little Rock, they all secondary market. We own asset in Oklahoma, and we saw the tailwind from the fundamental in that area, affordable rent, and strong occupancy, limited supply. And it's one of the assets that perform well in our portfolio, which Dave, I think, will touch on next. So, kind of recap, we still actively looking at a lot of deals, and we cast a wide net between the primary and secondary market, but each bucket have own distinct strategy that we're going after. We're just really picking our spot, finding a deal with a good story that we know that we can add a lot of value, taking over the operations. And those will allow us to outperform over time. So that's it from my end, and Dave, I'll hand it over to you to talk about operations.
Great, Cesar.
Thanks,
Thank you very
Cesar.
much. Indeed, just before you get started, I just want to remind everybody, we did have some questions beforehand, but anybody who, if there are any questions, please feel free to drop them in here. And thanks a lot, Cesar. That was very insightful. And yeah, Dave, please.
Yeah, sure. Thanks, Cesar. Thanks, Daniel. Good afternoon, everyone. Building off of Daniel and Cesar, I'm going to kind of give a bit of an update on some of our thoughts on the DFW market conditions and what we're seeing in our portfolio specifically. So starting with the kind of the broader DFW area market, put two charts here. One's on occupancy and market rent, and the other's on absorptions. They're kind of the same story, but I think they highlight what's going on in the market pretty well. So first, starting on the chart that includes market rents, as you can see in the graph, it's a little bit the market rents have kind of been bouncing up and down since the kind of peak in 2022, but certainly in a downward trend. So during the second half of 2023, Class A, Class B, which this is what is being shown in this chart, rents dropped about 3%, over that second half of the year. This is, these are the advertised rents. It's not factoring in concessions. I think concessions are very difficult for groups like CoStar to capture, or we're seeing concessions all throughout the market. And if you factored in concessions, I think these numbers would look far worse, but it's not being displayed here. So I just want to make sure I highlight that. Then on the occupancy side, you can also see that pretty much the DFW area market has been in a free fall since the peak in 2022. While vacancy rates vary by submarket, the data in the chart, is generally consistent with what we're seeing in our market surveys, particularly in areas where there's a lot of development activity. So, it's projected to bottom out here, but for now, the market remains very challenging, and it's on a downward trend in terms of occupancy. I mean, it's now down below average occupancy are down below 90%. So it's been a long time since that's been the case in the DFW area. A big part of that reason is the next chart, the absorption, net deliveries, and vacancy chart here. So in 2023, new units were delivered more quickly than the market could absorb. And, as a result, we saw the vacancy tick up. Right now, there are about 58,000 units in the DFW pipeline, 20 to 30,000 to be delivered in the next 12 months. This is actually down, considerably from the 65,000 units that were in the pipeline last quarter. So, but the absorption or the deliveries have been outpacing the absorption. As you can see, those are the deliveries are the blue lines in that chart, and the absorption is the orange. So for most of 2023, actually all of 2023, deliveries outpaced absorption, and that put downward pressure on rents and increased the vacancy rates across the DFW area. This is projected to change in the second half of 2024. We're seeing a little bit better picture as the more there's fewer apartments coming online. It even gets better in 2025. Part of that's due to interest rates. Part of that's just due to the natural cycles. But it's reason to be optimistic as the absorption will kind of catch up with the deliveries, and hopefully we'll see a stabilization of the occupancy and rents at that time. So I guess we'll go down to the next slide. Yeah, so moving to next slide. So this is kind of the portfolio leasing trends that we're seeing at our properties. So 2023 started off pretty strong. It was the first half of the year we saw good rent growth. Our occupancy average was roughly 95%, but in the second half of the year we kind of trended down, and by the end of the year at our Class A and Class B properties, we were below 92% average physical occupancy. Again, this has a lot to do with the deliveries and the new product that's coming in to the markets where we operate. But it's also just a general slowdown in the numbers of people and the economy. Some of the feedback we're receiving from our property teams is that, and it's reflected in our CRMs, is we're just not getting enough bodies through the door. It's compared to the height in 2022. It's a little bit concerning to see how much it's slowed down. It's dramatic. That's partly seasonality in Q4, but it's also, again, it's the new product and just kind of the general economy. So looking forward to Q1 here, really the second half and rolling into spring, to see if that trend breaks and we start to move up, which is common at this time of year. But for now, the numbers remain low. Economic occupancy, again, as our physical occupancy drops, the economic occupancy has also followed suit. We've been having to offer concessions. It's not uncommon for us to have to offer up to a month free to remain competitive in our markets. As Caesar noted, some of these lease ups are giving away multiple months free, and we are competing directly against them and at our properties, at least at a couple of our properties, and that's challenging. It's challenging to match that. It's challenging to, as they build, a lot of these developments build in concession budgets into their projections whenever they come online. So it's hard for us to match their concession levels, but we do everything we can to kind of maintain our occupancy. But as they, fill up, we expect some of those concessions to go away. As far as our lease rents, they've kind of mirrored the chart that was on the previous slide, where our new lease rents have dropped considerably. We've actually gone backwards towards the end of the year. So what was a strong first half of the year, even into Q3, we've had to cut rents in order to maintain our occupancy. So these rents are market rents. They're not even considering concessions. Whenever you factor in concessions, our rents have decreased, in some cases 10% from the highs in 2022. but, you know, we're trying to maintain a market rent, push it into, push the kind of the incentives into the concessions, so that when, you know, the new supply is absorbed, we can hopefully, you know, move back to those stronger rents that we were experiencing, you know, in 2022 and the first half of 2023. Renewal rents, as kind of indicated in the chart, have been, you know, a continued source of strength. You know, we have been able to kind of increase renewals, even as the turnover has continued, and, you know, for a while, there was kind of a gap between, you know, the highs we had in 2022, and then some of the people had renewed just before that, and we were benefiting from that. Well, we've gone through that whole cycle now. We're still able to push renewals a bit. However, you know, it certainly has declined. And, you know, and as our vacancy has increased, we've kind of gone to, you know, providing more incentives, lower increases to kind of maintain our occupancy. As you can see kind of in the chart, some of our lowest renewals percentages occurred during the summer of last year. As we kind of decreased our, you know, renewal increases, we saw those percentages bump back up towards the Q4. So it's a balancing act, but it's certainly a place where we feel like we can still, you know, move the needle a bit, and that's been helpful. Jumping down to the next slide. So these are touching on our areas of focus for 2024. Occupancy remains, you know, our primary focus. All of our marketing efforts, our concession efforts, our lease rents, everything is focused on maintaining a high physical occupancy. It's always been our philosophy that, you know, from a higher physical occupancy, you can, you know, whenever the market turns your way, we can, you know, push faster. Unfortunately, just due to the challenges, we've dipped, you know, as indicated before, below where we normally like to be. So, you know, we're again completely focused on that item and trying to push it back, you know, within reason, and using, you know, the strategies of concessions and other things at our disposal to kind of push that back up into the mid-90s. You know, related to that is our marketing. So, you know, we use all kinds of sources for marketing, you know, ILS systems, you know, the pay-per-click, targeted advertising, all of that. Lately, we've been focusing our efforts on pay-per-click and using locators. Historically, DFW has not been a locator market, compared to, let's say, places like New York City, where it's common for renters to use brokers to find their new homes. DFW has not really been that way, but it's turned that way a little bit lately, and we've had some success there. So, you know, it hasn't been a part of our strategy in the past, but it's now becoming more of a part of our strategy for 2024, and also more targeted advertisements and campaigns through Google and social media. Another focus is real estate taxes and insurance. So, you know, outside of the mortgage interest and payroll, you know, two of our biggest expenses are real estate taxes and insurance. And, you know, we do different things to keep those expense items down. Primarily with real estate taxes, we're pursuing, you know, discounts through the appeals process and litigation. And in the insurance arena, we are really focused on getting as many bids and quotes as possible as our renewals come up, just so that we're making sure that we're getting the best pricing available. It's very challenging. Not 100% sure what 2024 will bring. You know, in 2023, at some of our properties, we saw premium increases of over 30%, highest we've ever seen. So hopefully, you know, 2024 will be a little bit better year. But we're being proactive and working with a number of consultants and brokers to obtain the best quotes there. And finally, you know, capital improvements, maintaining our assets is a priority for us, you know, even despite some of the challenges on the revenue side of the equation. So we're working with suppliers, contractors to kind of keep the prices down on that, but we do have some, you know, significant capital projects underway and plan for 2024 to hopefully drive value, or at least maintain value at the properties, and resulting in increasing rents. So It's kind of it as kind of an overview for 2023 in our operations, and I'll hand it back to Daniel. Any questions?
Perfect. Thank you very much. Thank you, Dave, and thanks a lot, Caesar. And thank you, everybody who joined. So we do have one or two questions that we want to make sure that we touch upon, just to make sure we can get, for those who submitted. So one question we have here, Steve, is thank you very much for the question. And it's weathering the pain for possibly for a year or two. How do you see that relating to your offerings as far as preferred returns, classically 5 to 6%? So if I understand correctly, Steve is asking basically, how do we plan to position when we have offerings the pref, if interest rates are up, then theoretically the pref should also be up. So I think that for us and our offerings, the pref has always been pretty deal dependent. It just depends on the deal and what the dynamics of the deal are. And obviously it also correlates to what the risk-free rate is. And so if the risk-free rate is higher, then it makes sense. Then also the pref would need to be higher. Generally our prefs have been more in the 7 to 8% range. And so that still is above the risk-free rate. But I think that's kind of how we're still thinking about it, that it does need to be at a premium to the risk-free rate. Dave or Caesar, do you have anything to add on that?
Yeah, the only thing I'd say is, also, typically our prefs have been cumulative. So as far as weathering, if we're not hitting our pref, it is, for the investors in the deal, that is, it's cumulative. So that, that it will be in better times, or when a transaction occurs, it'll be paid out at the pref rate. Okay,
great, thanks. And then Dave, I'm gonna, maybe if you can think about this one, but this is the one that every real estate owner or anybody, investor or anybody having to do with real estate wants to know. But other than the heavy factors like insurance and inflation, do we see the factors improving in our favor? So basically, do we see things like insurance and inflation and those factors and coming up? Especially Dave, you deal with insurance pretty heavily. Do you see any of that ever coming back into our favor? I mean, is there any way that we can go back to the good old days of having, decent premiums?
Well, on the insurance front, it does not appear to be that way. There's no indication that that is getting better, at least in the state of Texas. So I wouldn't. I'm hesitant to say that part's getting better. As far as other expenses, inflation, there are some signs that is cooling, particularly in labor costs. So what we've noticed, let's say over the second half of 2023 is a lot of the job openings that we've put at, for the property positions, we're starting to get actual applicants. We're starting to get people that are qualified who are interested. Before it was very difficult to find people, and people who were applying for the jobs had very high expectations. Now we're having more supply of good qualified candidates, and that's keeping our costs down a little bit, and also just improving the employee pool and who we're able to hire. So there's some positive signs there. As far as our other expense items at the property, yeah, it certainly has cooled off a little bit. We were seeing some serious increases, particularly in products like carpet and appliances, large expense items. Those have really kind of stabilized. They're still elevated. Some cases they've gone backwards a little bit. In flooring, in particular, we've seen some price discounts that have occurred. But this is coming off of massive increases. So we're still higher than we were, but it certainly has cooled over the last 6 months or so.
Okay, so I do think, Dave, correct me if I'm wrong, there is some hope with the values of real estate, that appeals may be more favorable than for real estate taxes, may be more favorable than previous years. Is that not the case?
Well, yeah, I think that's a fair, certainly within our expectation that, cap rates have increased, and, in Texas, the counties who are, making these decisions, and, the assessment offices are taking that into consideration. And another thing that happened is Texas passed some property tax relief. I think we touched on that in one of these calls that is meaningful. Certainly it's been very meaningful. So all those things have helped in terms of our real estate tax, potential liability. Still a little bit early to see how the cap rates, have, how they have adjusted as far as our 2023, taxes. There wasn't really a whole lot of adjustment between 2022 and 2023. A lot of that occurs, in my understanding anyways, the assessment offices are actually working on it towards the end of 2022, and then they put out the 2023. So we didn't see the big adjustment there on the initial assessment. Now the appeals processes are still ongoing. We'll see what happens for 2024, which should be coming out, I guess, in the next couple of months. And we'll see if they've adjusted their cap rates, or not, or have adjusted as much as the market has moved. That's really the question.
Great. All right, thanks. And I'll just try and also one other question that was submitted. So what is HLC Equity's approach to secondary markets and even tertiary markets? How do these markets fit into the company's overall investment strategy? So Caesar, you did touch a little bit on locations and the various stuff that we look at, but maybe you can just, high level give a summary of how we're looking at those different secondary and tertiary markets in our overall investment strategy.
Absolutely, we'd love to. So we've been spending a lot of time tracking a lot of secondary and tertiary markets for us. The reason why we like those markets, I think there's a few reasons. First of all, it comes down to the lack of supply coming online. That will give us a long tailwind for the investment overall. There's a lot less institutional focus on those areas, so we can compete better, so we can get the better pricing. Also, a lot of this market, the rent naturally is affordable, by design. So with that, we can get better financing terms from agency, especially with Fannie and Freddie. They are very mission driven. They give us better financing rate and terms for those deals. So that allows us to juice the return a bit more.
Right.
And last but not least, is that the secondary market, kind of tying back to insurance. We've seen insurance rate in coastal market jump up 2x, 3x, sometimes 4x. I was talking to one of my friends who at another shop. They own asset in Houston and Florida. Their insurance premium in their asset going from $800 a door to $3,000 a door within a year. And he joked with me that all the work he'd done over the last 3 years, essentially he worked for free for the insurance company. But there's some truth in that. So when us looking at secondary market, within an hour of the primary metro that we've been spending times on, and also in the Midwest market, those have lower insurance premiums, which allow us to control costs a bit better. And also overall, kind of look at holistic level on our portfolio, that will diversify the risk, and that allow us to get better insurance rate premiums. And those are the reason why we're very bullish on those area. A lot tougher to source deal because not a lot of volume coming out of those area. That's why we cast a wide net, multiple different states to see which one will fit with our returns.
Yeah. Okay, very good. All right, well, I'd like to take the opportunity now to thank Dave and Caesar for joining us and giving us their insights. And thank you everybody for joining, for all of the participants, and be on the lookout for additional content coming up. But for now, that will be it. And thank you very much.
Thank you.
Take care.